Have you ever watched a movie where someone mentions a stock or heard a wealthy person casually talk about owning shares as if everyone knows what that means, as if the whole room understands it? Stocks are everywhere in our culture. They're referenced in films, news headlines, conversations about success, yet very few people stop and ask the simple question of what is a stock? Stocks are one of the most misunderstood concepts in modern life. Some people treat them as lottery tickets, others treat them like numbers on a screen. Many talk about it confidently without understanding what they actually represent. So today, we're doing something simple. No hype, no shortcuts, and no promises. Just a clear explanation of what stocks are, how they work, how they exist, how they're valued, and what risks they actually carry. Because if you don't understand what a stock is, you don't understand the system that you're unwillingly participating in. Alright, external power set. Both batteries on, standby battery test. Check. Standby battery on. Initialization. Flight plan. Check. Takeoff configuration set. Accept takeoff speed. Initialization complete. At its core, a stock is ownership. When a company is created, it is divided into shares, and each share represents a fractional ownership in that company. If you own a share, you own a claim on the company's future profits, a claim of its assets if it's liquidated, and sometimes voting rights in corporate decisions. You are not lending money, you are not guaranteed returns, you are accepting a risk in exchange for potential future value. This distinction is very important. Okay, let's get the APU on. Start, then on. Alright. Good start. APU percentage RPM is going up.
Custom OK.
Let's get the floodlight on and the lights. Passenger safety as well. Alright, let's set my auto throttle to 250 knots, manual speed. Companies issue stock to raise capital. Instead of borrowing money and paying interest, a company can sell its ownership to expand, to invest, to survive, to scale faster than debt alone would allow. This is why the stock market exists. They connect businesses that need capital with investors willing to take the risk. No guarantee, just exchange.
Concord Ground Cessna Alpha Sierra X-Ray Golf Sierra Mike ready to taxi IFR.
Cessna Alpha Sierra X-Ray Golf Sierra XC2 and hold short of runway left using taxiway Mike. Contact tower 123.9 when ready.
Taxiing hold short runway 1 left taxiway Mike Cessna X-Ray Golf Sierra.
Stocks trade on exchanges like the New York Stock Exchange, the NASDAQ, London Stock Exchange, and other stock exchanges globally. The exchange does not determine value, it provides liquidity. Liquidity means you can buy when you want, you can sell when you want, prices update continuously based on supply and demand. Without exchanges, stocks would exist, but they would be difficult to trade, price, or value. Stock prices move because expectations change. Not emotions alone, not headlines alone, expectations. A stock's price reflects what investors believe about, whether it being future earnings, growth, risk, interest rates, economic stability. If expectations improve, prices rise. If expectations worsen, prices fall. Markets are forward-looking. They price the future, not the present. That is why prices can fall when earnings rise. Prices can rise when economy looks weak. The market is not reacting, it is anticipating. A stock is not the business. It is a financial claim on the business. This distinction explains a lot of confusion. Like a great company can have a very overvalued stock, and a struggling company can have a very rising stock. The market does not reward quality alone. It rewards outcomes relative to expectations. That's why understanding valuation extremely matters. At a basic level, stocks are valued based on future cash flows. The idea is simple. A business generates money over time. Owners are entitled to that money. The value today depends on how much money arrives later. This is the foundation of discontinued cash flow analysis. Future cash flows are estimated, adjusted for risk, and discounted back to today. The higher the uncertainty, the lower the value today. No formula removes uncertainty. Valuation is not precision, it is structured judgment. In short term, stocks are unstable. They reflect fear, confidence, liquidity, policy changes. And in the long term, they reflect productivity, profitability, and economic growth. This is why time matters more than timing. The longer your horizon, the more stocks behave like ownership. The shorter your horizon, the more they behave like a speculation. Most mistakes come from confusing the two. Stocks are not isolated. They interact with interest rates, inflation, central bank policy, government spending, economic cycles. When rates fall, I'm talking about interest rates, future cash flows are valued more highly. Stock prices tend to rise. When rates rise, valuations compress, risk is repriced. This is structure and not a coincidence. Stocks are not a shortcut to wealth. They are a mechanism for allocating capital over time. They reward patience, discipline, understanding. They punish impatience, overconfidence, and ignorant risk. Most losses don't come from markets collapsing. They come from misunderstanding what was owned in the first place. Stocks are not numbers. They are claims. They are expectations. They are risk price over time. If you understand that, you stop reacting emotionally and start thinking structurally. And that's the difference between participating in markets and being controlled by them.